RLV. So this is just a 50-period simple moving average. We have this formatted on a line slope of 2. So if it's got 2 degrees or less on the slope, it's going to give you a yellow. 2 degrees or more, it's going to give you a green, or it's going to give you a red. Now, if you set it higher, it'll stay yellow longer. But we want that yellow to be very sensitive. You want it to only be yellow when it's really particularly flat. So 2 really is the optimal setting. And the MA Analytics, and I'll bring the chat room over, so if you have any questions, you can ask me while I'm doing it. Okay. You have, with 100 megabytes, well, you're super fast, super fast. You can, Donovan. You can. You could do it on both. Now the MA Analytics right here, we don't really look, I don't really look at the slope. Here's the slope of the 50, and it's not in absolute degrees, and we really don't use it. We just look at the color. When we created it, we thought that looking at the slope degree would help us out. And in a sense, if you want to look in the upper left-hand corner, you can tell, when the slope is like 0.01, 0.02, you can tell that there's a color change coming. But it really just doesn't figure into our training. And you don't want to make it any more difficult than it is, or assimilate any more data than you have to. Now, the MA diff is not working. That's why we have to estimate overbought, oversold. And we need to get it working so that we have an absolute analytical tool to tell us that. Now, right now, we just don't have it, but we're going to make it. And that's just total volume crossing for the instrument. Now, let's do we'll do the 3 line, and we're going to do it so you can see it. Okay, so see the default comes in. What I'm going to do is I'm going to make it so you can see it. So I'm going to show you a little bit of nuance on it that I think it would be nice. It would be nice for you to know, since we're going over since we're doing a review. It doesn't matter what colors you put in, as long as it's not transparent, you're going to see it. So there's the 3 line. Now, what you're going to do is you're going to see this. You're going to get you're going to get this halo, or this is the first one is momentum. It's a good question. This is momentum. Right here. The second one is stochastic. And the last one is order flow. Whoops. I didn't know you had. Let me just copy and paste it. Take it out of here. I'm going to put it down here. Like stochastic and then order flow. Now, you're going to see that the halo is going to be blue even at times when the momentum line is yellow. And the reason is that here is the MACD crossover. And we don't have the momentum line turn green until the signal line, until the MACD line crosses the signal line. But here is where the MACD slope is positive. So when it starts up from the bottom and it heads up, it may have a while before it crosses the signal line, but we only care about the direction of the MACD line and its slope. So we just decided to be able to tell both things. So if you want to be able to tell when the slope of the MACD line is positive, you just look at the candle wicks. And even if this is yellow, you know that the slope is positive. When the MACD line crosses the signal line, then the actual line turns green. So it's actually doing a little more complex of an assessment. You really don't have to worry about it because what's really important is that momentum is increasing, and we don't really care about that crossover. We're just going to trade the slope of momentum on the 2 higher Uni-Renko multiple time frame charts. Now here stochastic and order flow went red, and you can see both these candles went black. And you can see here you had a long period of black, stochastic, intermittent here. And the candles, you can see, are changing color. So what you really only have to do is look at the candle halo. And it's actually easier to do an assessment with the candle halo only, because then you don't have to worry about the yellow MACD period. So if you took off the candle halo, you would not be 100% sure if this is yellow because the MACD lines are not moving in the same direction, or the MACD lines were both moving up with positive slope, but hadn't crossed the signal line yet. So the best thing to do is to keep the candle halo. And if you want to see the 3 line, you can. And you can see right here on this move down, all the way down. At this point here, you can't tell what the reason is because you have 2, but it doesn't matter. You don't have a 3-line alignment here for these 2 candles. And then here it's yellow all the way. Just like that. So just look at the candle halo. And you know, I mean, I took one trade on a black 3-line and it failed. So it is dangerous to do. You know, it could have failed for lack of volume. It was a risky trade anyway. But always get the 3-line aligned to the upside on a long trade. Always get the 3-line aligned to the downside on a short trade. It's very, very important, because it is doing a multi-time frame assessment. And I know you know how order flow is calculated. We put the market delta of the candles generated on the 2 higher Uni-Renko time frames into a 15-period SMA, and the slope of that SMA, if it's positive on both higher, the bulls are in control and this line is green. If the bears are in control with both SMAs red, then with this line is going to be red. So are there any questions about the 3-line? All right, good. Let me put in the pivots. Now the pivot indicator is set with a sensitivity of 150. On 150, it is low sensitivity. It's not going to give you a lot of pivots. And the small pivots, I don't have a whole lot of respect for. I mean, the market's going to move through them fairly easily, but these bigger pivots can cause you problems. Now, we have one of the few pivot indicators that adhere to Japanese candlestick rules. And the pivot will continue to trace. You see how it traces here? You still get it. It stops tracing here on this candle because in order to break a pivot, 2/3 of the candle body has to close below it. Only 1/3 of the candle closed below it here, so it continues to pivot. We're recording this. So the pivot is only going to break when 2/3 of the candle body closes below. Now, most pivot indicators do not work that way. They either break on any penetration, they use other rules, and this is really the way it should be. In addition, the pivot should trace off of the candle body, not the wick. And that's also Japanese candlestick dogma. And I see a lot of pivot indicators that come off the wick, and that is not accurate. It should come off the candle body. So it's a very good pivot indicator. And you can see how price here came right down to the pivot and came right back up. Now, the only thing we can say about the pivot indicator is every time a pivot is hit, it's weakened. So on the first hit, you should anticipate a hold. The second pivot, it's weaker. You should also anticipate a hold. On the third pivot, on the third strike of a pivot, you should anticipate a break. Now, it's very variable, and hitting a pivot is hit and miss. You have to also look at the size. You know that it turned the market once. So the market was heading down here, and it turned here. So there's a lot of buyers right here. So price came back down here, and buyers turned it back up. It never got through. Price came down here, and buyers turned it back up. Never got through. But then here, it got through the buyers. And part of the reason is every time a pivot is hit, it depletes the buyers. So the pivot becomes weaker and weaker. The 50 never loses its power because it's always changing. Remember, this is the average close for the last 50 candles. And the reason it doesn't lose its power and support and resistance is because it's a changing dependent variable. The pivot indicator doesn't change. So it's going to weaken. The 50 never weakens. Instead of weakening, it simply moves to track the last 50 closes. And those average closes, you have to say they're non-random. So this is an area of strong support and resistance, and we really do respect this. We have a lot of indicators that we don't use, and let me tell you, they don't work. I'm just looking for the best one to use to put in next. Let me put in the RLV because it's really important. Let me use the Uni RLV right here. And I'll show you something else too. I'm going to put this in. I'm putting in two indicators. Now, one we don't use. Now, if anybody who's listening wants it, we'll give it to you. If you own the full platform, you can have this indicator. I don't think it's going to help you much. But this, I mean, you can look at the E-mini. It's sort of dead. And this is the number of contracts crossing per unit time. And you can change it. If you look at the RLV, we have it changing every 1 minute. You can change this to days, weeks. Obviously, you don't want it, but you want to get it back to, let me get it back to minutes if I can. You want it changing every minute. And you can change it to 2 minutes, 3 minutes, 4 minutes. It doesn't make any difference. Now, what this does is it gives you an absolute value based on only one variable, a volume. And I think that's the most important way to assess volume. Now, I'll show you something about other volume indicators and why I don't think any of them work. Where's volume here? Volume. I think it's just called volume. Not volume zones, volume oscillator, not volume profile. Let's try VOL, volume. Now, here's a normal volume profile. And this is what you see on most platforms. And the reason, you know, I always hear people in seminars talking about volume spikes and how to trade them. And they look terrific in retrospect. Because if you look here, let me get a vertical line here. Right here, you can see how there's a spike on this candle, and this might be climactic volume, or actually in this case, it's huge volume turning the market. But here's the problem with it. You don't know whether or not there's large volume here because the candle just sat there for a long period of time, accumulating volume. I mean, sometimes a candle takes a long time to form. And if it takes a long time to form, volume is going to slowly creep up higher and higher. Other candles just fire through quickly. And they don't have time to accumulate a lot of volume, even if the volume per unit time is extremely high. So let's just take a look right here and look at the time. This is 9:41. Here's 9:44. It took 3 minutes for this candle to form. So likely a large component of the volume spike is the fact that this had 3 minutes to accumulate volume. Now, if we go here to this really tiny volume candle, this is at 9:44, and this is at 9:47. So this is just a very low volume candle. Sometimes on these very low volume candles, you're just going to see they move quick. 9:49, 9:49.42. So this is only 42 seconds. This is 3 minutes. So what I'm getting at, and I'm sure you understand it, is this volume spike could be due to the fact that the candle took a long time to form, or there's actually a large spike in volume and you don't know which one it is, especially when you look at a dead chart like this, unless you put the crosshair over it and check like this. And for me, in general, it just doesn't work. So what we did was, here's the number of contracts crossing per unit time, and this is called our volume hammer. And what this does is, it tells you in unit time, you're going to get, if I move to the right edge, you're going to get, the last line is going to wiggle. You're going to get a new line every minute. Now, it was difficult to create because this is a Uni-Renko chart. So as you move back, like if you go to here, you can't just put a crosshair under it, because this is moving every minute. You get a new line, and this is moving every Uni-Renko. So it's most accurate on the right edge, and here's what it's good for. It's good for taking a look at what is happening to volume. And if you look at the E-mini right now, you can see that it's not a market you want to trade, because it's dead. Now, there was a small volume spike here, and this is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 24, 25, 26, 27, 28 minutes ago. And then if we go back here, we can see where this volume spike was. Now, when you saw this in real time, this has real validity because it doesn't have, it's only time dependent. But on balance, it's information I think you already know from looking at this. I mean, when this thing is ticking like this, you don't need to look at the volume hammer to see that the volume line is going to be flat. And you're just going to stay away from trading this market. Now, if it's something you'd like to see graphically, and you have all the indicators, we'll be happy to let you have it. Only I don't think it's going to be that helpful for you. That's why we don't display it. I just wanted to show you how we calculate volume and why we think what we show is the best way to leverage volume. So let me take out the volume hammer and just a regular volume. And if you just pay attention to what's going on in the lower right-hand corner, you get a great assessment of what's going on with volume. Upper right, upper left here is total volume, total number of contracts crossed per the day. Now, a slope of 0.878, if we used it, you'd know that this is a strong uptrend here. This momentum, the 50 SMA as a reflection of momentum, is very strong to the upside. When it gets around 0.2 to 0.1, it's weak. Now, the next indicator, because I want to build on it before we get into the dots. Okay, let's do the levels. Now, if anybody would like a screenshot of the back here, they're welcome to do it. They're welcome to it. Now, this has fib retracements in it and volume data, and the halfback is the volume weighted average price, and I got rid of all of these retracements. I mean, if you're interested in Fibonacci, it'll work it for you, but I'm telling you, they're not going to help you. I mean, price is just going to move through them. Once in a blue moon, it's going to bounce. It's not something that you really should be interested in. But if you want to trade with them, you can do it. I just want you to know they're all here, and you don't have to use the fib tool from Ninja. And this is what you're going to get in default. So if you're not on Eastern time, like Giral was not on Eastern time, you have to change this, because the market for you is not going to open at 9:30. And what you want to do is you want to put in the market open time in your time zone. And this is what gives you the prior close and the open of the current session. And I hope I moved it, put it in. So I didn't put it in. I mean, you can play with it, but I don't think you're going to find that it's going to help you if you put in all those other areas. I think it's going to make things very confusing and make it more difficult to trade. And the one thing we don't want to do is to project data that we don't care about. So this line is the present session open, and this line is the past session close, and you can modify them. You know, they're all settings in here for how you want to. You see this dash line, dash dot versus dash. You can change how they project themselves. And there's the volume weighted average price right there. And I just put it to yellow, just to offset it in color from prior session open, from the session open to prior session close. And I think these are lines that also need to be respected as areas of support and resistance. The VWAP can cause lots of problems if you trade into it. And I traded into it yesterday. And yesterday I took one loser, and that was the loser when I traded right into it. And the problem was I didn't have the levels indicator on the chart. Now let's see the pivots. And then we'll get into the others, the good stuff. Let's look at the oscillator. Now the oscillator is unique. And let me explain to you a couple of things about it. The market moves in moves arithmetically, which is why you should never use an exponential moving average. Now, exponential moving averages are used in the MACD equation, and I personally don't like that, but there's nothing you can do about it. It's simply ingrained in the formula, and you can't change it. The fact that it's exponential is what gets that MACD line accelerating and decelerating into the signal line so quickly. Otherwise, it would take a long time for them to come in and move apart. But the market does not move like this. I don't think I can draw it here. Hold on a second here. I can draw it this way. I can't. It doesn't move. Price does not move like a bell-shaped curve. There's no periods of time where price curves up. It's hard to explain. It curves up and curves down like a bell-shaped curve, accelerating like a parabola. It moves arithmetically. So nothing should be to the power of 2. Everything should just be to the power of 1, because everything here is really arithmetic and not geometric, which is why exponential moving averages I don't think should be used, because this isn't a second order type of movement in price. These are all first order movements in price. This doesn't accelerate in a way that takes it off, that takes it off in a curved way, and where it asymptotes and goes up. It's all arithmetic movement. But we formulated this exponentially. And the reason we did it is for the same reason that the MACD is exponential. We wanted to get, here's the 50 line. And every time the oscillator line crosses, if it crosses to the downside, you get a down signal. If it crosses to the upside, right here, you get an up oscillator signal. And here, it's just to get the signals to occur more often, and then we back tested it. And it turns out that it works very, very nicely. And it's just one of those things. So we use it as an exponential. But that's really all it's doing. It's looking at the 50 line and looking at every time the oscillator line crosses the 50 line. If it crosses it to the upside, you get an up arrow. If it crosses it to the downside, you get a down signal. And when price right here, it's above the 80 line, you get these overbought signals, which I would like to remove, but I had a whole bunch of people in the room say they want to see them, so I keep them in there. But we don't use them, which is why I wanted to remove them. See, this is all overbought. All overbought. And I can't find anything that's oversold, but it just gives you the up red arrows. And we're looking for a down red arrow. The E-mini hasn't been oversold in a long time. Here it is, these, right here. Now, I'm just going to, since you're listening here, I'm just going to give you a little bit, I'm just going to tell you what I believe about overbought, oversold. I think that at one point in time, the oscillator made a pretty good assessment of overbought, oversold. But in current time, it's useless for overbought, oversold. At one point in time, divergence was a more powerful signal. but at the current time, it's pretty useless. Now, it does work once in a while, and I can show you right here that it does. Here is price making a higher high right here. Let me get this right. Where's the pivot? The pivot's right here. No, let me get this. Let me get it. You know what? You know what it is? This is right through a session break, I think. It's to the market open. I can show you, I mean, good examples of oscillator divergence where it actually does work. But in general, the signal fails. And let me tell you why I believe that not only does the oscillator no longer work for being overbought, oversold, it's the same reason that price action trading is now become so hopeless. Like, I spent a lot of time learning how to read price action about a, and here, this is the NASDAQ today on a, here's a C candle down. This is an engulfing candle. Here's, this is a dark cloud cover. And I think that reading price action, here's a trade out of consolidation. Here's our, this is a different signal. We can't use this signal on the Renko. And you see they all work here. And the NASDAQ gave us nice small moves here. Here's an entry, here's an entry, here's an entry. But these are all based on price action. And I think the reason that price action is so ineffective now is that so much of trading is algorithmically controlled. When computers control trading, they sort of obliterate the power of price action. And you like them, John? Okay. Hey, listen. If you like them, no problem. That's why I read your comment. Let me tell you why I don't trust them anymore. No problem. Listen, everyone has different styles, and I'm never gonna say that, you know, that my style is the only right one. But let me tell you why I think there's a problem with, in my opinion, with overbought, oversold, and trading price action now. And that is when the Japanese developed these candlestick patterns. And I wish I could put up, I'm just going to put this up really quickly. Oh, it's the wrong thing. I don't want to make this too esoteric because this is really just a review of the signals. But I'll just give you a little bit of my trading philosophy based on what I've seen. Here's normal distribution. Now, 100 years ago in the stock market, I just need one nice little simple, I get all this complicated. Now, 100 years ago in the stock market, here's a normal distribution. Every trader, almost every trader, had an equal amount of power in determining the direction of price. So you could say that each trade, that the power of the traders was normally distributed, with each one having an equal amount of power as it averages out. Now that is not true. Now, if every trader has an equal amount of say in what direction the market goes, then price action looking at engulfing candles, looking at periods of consolidation. They have tremendous validity. But what if there were 5 traders, and those were 5 institutions that had so much power, they overwhelmed the other 95%? They're going to skew this normal distribution. And what happens is, since there's just a few traders that are able to completely control the direction of the market, I think it really makes the power of price action much, much less powerful. And here, John, this is why I have a problem with overbought, oversold. And the reason is this. To me, the market is going to make a high when the institutional traders decide it's going to be the high. If they keep pouring money into the market to take it long, it's going to go long forever. And you know that an oscillator can stay overbought for an hour. This is simply because the institutional traders are pouring money into the market. The same thing with going short. It's going to keep going down until the institutional traders decide it's going to go down. As long as they decide, I want to drive it down. This is the same problem that you have with using Bollinger Bands, and why I think they totally are actually quite useless. Bollinger Bands as channels, I think they're they define 1 or 2 standard deviations, and they curve up and they curve down. But they again work best when all the traders have equal power. When only a small group of traders have an enormous amount of power, and those group of traders decide the market's going to go short, they can push the market along the lower Bollinger Band forever. So although the Bollinger Band is saying that at some point the market's going to move up, if all the traders had equal power, that would happen more readily than it is simply, say, one institutional player could drive the market down forever. So that's simply the reason why I think they have a little bit less validity. No problem, John. That's just my theory. I can't prove it, but we both know that oscillators can stay overbought, oversold for such an enormous period of time. I think that if it was 1945 or 1950 and the institutional traders had little power, and we didn't have all this this electronic trading, and we still had the crude pit with open outcry, and there was still actually a gold exchange without open outcry, then these individual traders had a lot of power. And then an overbought, oversold market also had a lot of power. And you can anticipate a move off an overbought and a move off of an oversold more readily. Now I think it's just with big money controlling the market. The way we leverage it is simply by doing a multi-time frame analysis, because we want to be in when those multi-time frames align, telling us that big money is in the market. Now, that's why for me, one of the hardest things to do is to tell when a market's overbought and oversold. Now, what we're going to do is determine the way I think you do it, and the way we've done it on the E-mini on range. We have to do it on Renko. We just haven't yet. Is analyze a year of data and determine the average true range of the market for that year. So let's say over a year, you can determine how far the market moves on average. Then you can determine where it starts to get oversold and overbought based on math. And that's how we did it with the E-mini range and all the other range charts. Well, here's the thing, John. Let me show you mathematically what divergence is, and I don't want to get too off the track here. I mean, you know that you get divergence. You know that all oscillators are based on the comparison between the high of a move and the close for a long, and the low of a close, the low and the close on a short. So as the high, it's not the close. Yeah, I'm right. When the close of the move continues to approach the high of the candle, based on the oscillator formula, the oscillator line is going to rise. When the close of the move starts to retreat off the high, then the oscillator is going to slowly start to turn down in reverse. When the close of the move approaches the absolute low of the candle, then that oscillator line gets pushed down. Now, oscillator divergence is simply price making a higher high, but the close of the move not approaching the high as much as it did on the previous move. I hope you can understand that. So on a strong move up, the close of the candle will be very close to the high of the candle. And then on a weaker move up, the close of the move is going to be further from the high, but it's still going to be a long move. So when that happens, that's when you get divergence. Here, the oscillator pulls up really far because the close is close to the high. Here, the oscillator pulls back because the close of the move is further from the high. I mean, you're losing momentum. And that anticipates, since momentum is waning, that the market's going to turn. And again, if all traders had equal power, then oscillator divergence would be a very good signal for a reversal. But now it's a difficult signal because the institutional traders can just come in and ram it right through. So, and every oscillator, Williams K, RSI, stochastic, all use this relationship, the relationship between the high of the move and the close of the move. Even though they have different formulas and twisted out in different ways, this is the comparison that's made in that formula. Okay. Gene, in a sense, no problem, John. Thank you. All we're looking for is markers. Ultimately, what are we looking for with all the indicators? We're looking for a marker of money flow, because that's all that matters. We want to know if money is flowing into the market or money is flowing out of it. Nothing else matters, because that's the prime mover, is money. So the reason we use order flow, stochastic, and momentum is because when you get a multi-time frame alignment of those three forces, you know that the institutional traders have to be participating in the market move. Now, this oscillator gives us nice signals, and they usually occur at the high of a move and at the low of a move. And it didn't have to be the case. And they don't always occur at the high or the low, but they oftentimes do. And the reason that happens is because we made this an exponential assessment. And if you're going to get an entry signal, you want it close to the low and close to the high of each pivot. And this does a really good job. It's not going to be perfect, but it's looking to get a long signal on an appropriate up move, but the best place to get that is at a pivot turn. But what we're looking to do with all these indicators is simply determine money flow. Now, if we looked at momentum on our trading chart, it would give us no useful information, because all it tells us is where momentum has been, doesn't tell us where momentum is going. But if we get a multi-time frame alignment of momentum, it does look out into the future and gives us a great idea of where money is going and where price is going to move. It really does have predictive value. And I'll tell you, I would say 80% of the moves of the trades in the room that I take that are failures are I cause them. And I don't mind saying that, but it's the truth. And then sometimes we just get a move that we miss. I mean, but you can see here's a perfect move. But I want to get back to the indicators and why there's such an accurate assessment of money flow, because that's all we're looking for. That's all we want the indicators to tell us, is where are the institutional traders putting their money and are institutional traders participating. So we're looking for a multi-time frame alignment of order flow, stochastic, and momentum. And order flow is simply who's in control, Gene, on the dome right here. Who has the most say? Who has greater market depth? Are there more buyers on the ask side or more sellers on the bid side? And that gives us the market delta. And if you've heard my lecture before, you know that the market delta, only 66 2/3% of the time, closes in the same direction. It actually predicts the direction of the candle close. So by putting them in a 15-period SMA, you get a really good idea of who's in control, the bulls or the bears. But order flow is only one marker, because momentum and stochastic are individual forces. Because you see, if you just lose one line and the other two are pointed, and you wind up with a black candle body or a black halo, it lowers the predictive value of getting a winner. So all you need is one of these three to not align in your trade, and the predictive value of getting a winner falls. So they're really equal in force. So order flow is a good marker of money, but so is momentum, and you're going to see why. So our next indicator we'll look at is let's see. We'll look at the quant lines, and let's look at the quant E-mini. Now I just want to make them number 2. In order to do that, I have to do this first, because there won't be enough room, and then I'll reopen it. Okay, I'll just leave it like this. It's fine. Just for teaching, it's fine. Now the quant, in each 3 lines of the quants, there are 3 markets. There are 3 markets here, 3 markets here, and 3 markets here. Now, the quants on the E-mini are different from the quants on crude. I should mention that. On the quants on crude, there are only 3 markets. So we have these set at different speeds. That's all. Here, you're actually looking at 9 individual markets. And what we do, we know that when the E-mini goes up, at least 70% of the time, the Russell goes up. At least 70% of the time, the NASDAQ goes up. and at least 70% of the time, the Dow goes up. These are correlative markets. And at least 70% of the time, bonds fall. And at least 70% of the time, treasury notes fall. Now, the others we kind of keep hidden because it took us so long to do them, but also certain precious metals fall. And when you trade the Forex, the correlative markets are really key, and also certain currencies. So what we want is for all of this to happen. And when all of this happens, all these quant lines will go green. The markets should rise when the E-mini rises do rise. And the markets that fall when the E-mini rises do fall. And when that happens, all three lines go green. And what that really tells you is that what you're seeing is the institutional rotation of money from one asset class to the other. And it's real simple because when risk is on, they're going to buy stocks. And they're either going to buy them in the NASDAQ, the Dow, the Russell, or the E-mini. And when risk is on, they're not going to buy more safe investments like treasury notes, treasury bonds, precious metals, or currencies. Those are the safe investments, and they only are going to put money here when risk is off. So really what happens in the course of a day, now non-institutional traders make a difference here. So that's why we want all of these to align, to tell us that there's an institutional rotation of sector money, of money from one sector to the other. And the middle one, or the middle quant in the E-mini, has the markets that have a 0.9 correlation. So they're really tightly correlated. Now, 0.9 is not 100%, but 0.9 is a very high correlation. That's why I always look for that middle quant, because it's going to move in the same direction as the E-mini 90% of the time. The others are going to be closer to 0.7. If you have them with you, it's great, but that's the line you want. And if you don't have it, that's where you get into trouble. Let me see this one other question. 9, there are 9 on all the index equities. So the Dow, the NASDAQ, the Russell, and the E-mini all have 9. And the NQ is really heading down right now. I'll just show you. Look at this. It came up and now it's heading back down again. I was just watching it on another chart. There's 9. On all the other markets, there are only 3. But the reason there are 3 quant lines is we change the speed of these markets. And determining the speed of the markets is very hard because some of these markets move slow and some of them move fast. And we want to get them so that they work with the speed of the E-mini. So that's why they're so important, because they're really almost a direct reflection of institutional money flow. So when you have red, 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 you've got a great idea here that the market's going to fall. Now, the lower the volume move, the lower the day, if there's a low volume day, the quant lines are going to correlate a little bit less accurately because all the markets tend to move more slowly. And that's what happens here on a low volume E-mini day. But in general, you can see right here is where the intermediate kicked in. Now, you don't have an entry here, so you just can't get this move. The best thing you can do is take an entry on a pullback and a continuation. Now, where are we here? Well, here we're in the middle of the night. But if we go here, you can see, well, let's see here. This is at 5 o'clock. Let me go to the middle, like right here on this move up. You can see that intermediate quant, how well it does. It calls your long signal here. It confirms your long signal here. It's really a great line, and that's what the quant lines are really doing. It's a really easy way to remember it. That we couldn't find 9 correlative markets because with the index equities, you get 5 right off the bat. You get the other 3 index equities. For the E-mini, you get the Dow, NASDAQ, and the Russell, and you also get Treasury notes and Treasury bonds. Just excuse me 1 second. So those are the quants. So let me move on. Now let's do some. Hold on 1 second. Let's do the. Hold on. Let's do the dots. Here's the fast, and here's the slow. Now, just hold on for 1 second. I'm sorry. I'll be right back. Give me 30 seconds. Now, here's what the dots do. We're looking at the E-mini. The dots are simply looking to leverage the direction of the NASDAQ and the Russell. If we take an E-mini trade long, we also want to take a trade on the E-mini when the Russell and the NASDAQ are long, because we know they correlate in the same direction 70% of the time. So they're giving us a real additional way of making sure that our trade is going to be this. No, I know Mercedes, they're really, the quants on the DAX are excellent. We found really good correlative markets. And that's one of the reasons I really like the DAX, because I mean, everything locks in and it flies. So this is what we're looking at here. We're simply looking at other markets. And I don't think that you can trade really well on any index equity like the E-mini or the NASDAQ or the Dow or the Russell without taking into account. No, I know. I was looking at your comment. That's why I brought it up. No, and I think you're right. Without looking at the direction of the other index equities. I mean, if the Russell is making a move down, and you saw today, you know, now we're trading the Russell and I'm sorry, we're trading the NASDAQ and we're trading the E-mini. And you see sometimes they don't move in the same direction. But when they do move in the same direction, that's the most advantageous time to take an entry. So, and we simply put them on two different moving averages. The X's are the fast moving average, and the dots are the slow. So for the slow to align, you need a stronger correlation. The fast will align quicker. In addition, you can tell. Alan, they should be in your list. If you don't have them, just call and Sergio will put them in. They should be in your quant list here. See right here, RL Quant DAX. Okay. Well, Khalid, let me try to, here's the difference, because you're right. There really is some overlapping, you're exactly correct. There is some overlapping assessment between the dots and the X's and the quants. Here's the difference. Here, in the middle line, you can't see what market is doing what. Here, what we did was, not only do we have a dual time frame, but the color of the dots, as long as there's a correlation in slope degree here, you're going to get a green. But here what we did was, if you look at the color of the green, it gives you the power of the correlation. And if this is a light green, it means that the trend is weak. When it's darker, the trend is more powerful. So you can make a more objective assessment of the correlation and direction between just two markets, the NASDAQ and the Russell, looking at the dots and the dots. That's all. That's really all it is. It's being able to take a little piece out of this and put a magnifying glass to it and make the information a little more valuable. So like if you get this one, you see if you get this 1X here, and it's a very, very light, it doesn't have much meaning. In addition, you can see here that these are separate colors. One's green and one's red. Now, the reason the quant line is red is simply because these are set on faster time frames. This hasn't turned color yet. So you want everything to align. These dual dots, and when they're dark, dual dots are the strongest. And along with the quants, really give you a really powerful one-two punch. And I'm telling you, I won't pat myself on the back, but I invented these. I mean, in my trading, when I traded the E-mini, I always like to look at the NASDAQ, but it's really hard to make an assessment of the NASDAQ because it's all over the place. What you really want to look at is the moving average of the NASDAQ. And if you just look at price moving around on the NASDAQ, it can drive you crazy. And sometimes it just fouls you up. But looking at a moving average is really much better. So those are the dots, and that's what all of the dots do. And that's why we have to make separate dots for each market, because you can't use the YM dots on the E-mini. You can't use the NASDAQ dots on the E-mini. So that's why it takes us a while to build out each workspace. So those are the dots. Now, the other thing that I wanted to show was the bias, because bias is actually looking at the market you're trading. Everything else is looking at other markets, but we also want to do the same thing with bias. Let me find that. I'm sorry. I know everyone else can see. Here it is. Now, bias has no inputs because the indicator has all of the coding in it to do everything automatically. So what bias does is it looks at the multi-time frame assessment of the E-mini. So here's the second strongest. Here's the strongest stop. And here's the weakest stop. These three colors. Now, when you've got this dark green, it's the best time to take a long. And I have to tell you, remember that these colors, most traders' software that have background bias, the background bias is formed by price on the trading chart and therefore has no value. This does not look at the E-mini 2 Uni-Renko. It's looking at the E-mini 4 and 6 Uni-Renko. So when you get a dark pink here, it's not coincidence that you get two down moves right here that are perfect. Down and down. And it's also not accidental that if I show you a long period where there is no background bias, like right here, this is a great example. Look what happens when there's no multi-time frame alignment of the E-mini. Price just moves crazy. So you can really see how powerful a multi-time frame alignment of the market you're trading is. And I think of all the independent variables, this is the strongest. No matter what the signal, be careful when you trade it in this area where it's clear. And if you want to take a little bit of liberty and use a little bit of trader discretion, do it when the background bias is dark green or the background bias is dark pink. Because here's where you, right here, here's where you're going to get your great down move. Let me see the question. Oh, you know what, Khalid? We did do that. But you know what? NinjaTrader doesn't allow it. It doesn't allow us to put these dots. Oh, here's the problem. We can either put them below or above. I'm trying to remember what we wanted to do. We wanted to change this. We wanted to do that with the dots below for above for red and below for green. But we couldn't do it unless we made a separate indicator. So in other words, we'd have to have a red dot and a green dot indicator. So it would have caused Sergio to have to make two more indicators. Okay, you understand what I'm saying? Like NinjaTrader will not allow a single indicator to flip the direction of these dots. So that's the only reason we don't do it, because other people have asked us to do that too. Put the green below and the red above, but we'd have to have two more indicators. And it's something we might do, but it'll take Sergio a little bit more time. So this, I think, of everything you look at, is the one to pay the most attention to. If a signal is going to fail, it's most likely to fail when you have clear background bias. Right here. And here's a huge area of clear background bias. And look at the chop here. I mean, there's nothing in here you could trade that's low risk. So if you don't have FOMO, which is fear of missing out. Remember, Chandra, that the color of the dot determines the strength of the trend. This light green is the weakest, shorter. This is a short-term trend. The lighter are the weakest. The darker are the strongest. And there are three colors. Here's the lightest pink, here's the intermediate red, and here's that darkest, almost maroon color. You get the same thing with the dots, the same three colors. So you can not only assess that there is an alignment, or the market's moving in the same direction, but how powerful that alignment is. There's your lightest. Let me find a better place for it. Here you know what? You can look right here. Look at the dot indicator. Here are the dots. You see you have the three colors, the maroon, the red, and the pink. Then you have this very pale green, the yellow green, and then the dark green. So those are giving you the strength of the trend, and they do matter. I don't look at them that carefully, but you actually should pay attention to them because they do have predictive value. And again, because I don't want there to be any confusion. They are looking at the same thing that the intermediate quant, and I'll tell you the quant, the strongest one, obviously, is the one that has the index equities in it. This is the one that has the NASDAQ, the Russell, and the Dow. So this is the strongest one. Another one has treasury notes, treasury bonds, and a currency. The other one has precious metals and a currency. They correlate, but here's your real tough one. And they do look in a way at the same thing. They just look at it in a different manner. That's all. And you're going to be periods of time where you get the dots, but you don't get that intermediate. But in general, if you look, you're going to see without the intermediate quant, you don't get the dots. See right here, you get the dots. And you're not going to get them when you don't have that green intermediate. And you see you have that red intermediate here, and they're the dots. Because in a sense, they are doing the same thing, okay? They're just doing it a little bit of a different way, that's all. You know what it is? You know what it is? When you have two indicators looking at the same data in a different way, they give you more specificity. And the more specificity you have, that's where you get specificity. Specificity is where you're allowed to avoid false negatives, and those are true negatives. And true negatives are where you would have taken a trade and it would have lost, and only take true positives. So you could see, even though today wasn't the greatest day, we were easily able to sidestep tons of chop, especially on the NQ. I mean, there were a ton of trades that we could have potentially taken in here where we had some dot alignment, but we didn't get quant confirmation alignment. And you see this trade that I missed? It was the one trade where they both lined up right there. When you got that dual confirmation right here, up it went. And it was a winner. Look what happens on these short trades. No go, no go, no go, no go. Here, no go, no go. Very, very easy to sidestep because the intermediate quant didn't let you trade. So if you take everything in its totality, the dots, the oscillator, the background bias, and the quant lines, they're going to really keep you out of chop. And you really, really want that intermediate quant on both the E-mini and the NQ. Because on the NQ, they're also the index equities. And if they're not in your favor, the likelihood of this following through is small. Look what happens here when they both align. Now, and it's really important to remember that none of these things are looking at price on your trading chart. And these are green. These green lines are predicting price is going to rise. Price rising doesn't turn these green. This is what makes them independent variables. If they assess price on your trading chart, they're dependent variables and they're useless. So all the indicators in NinjaTrader and all these platforms that simply look at data on your trading chart are not going to help you. And I'll just give you a quick word on Fibonacci, and that is it don't work. And I could spend an hour talking about it, but it's just a hoax. But trust me, I mean, we've looked at a year of replay data. Fibs just don't work. I don't know how anybody ever thought that they would. And I could give you a mathematical reason why, but it's a little esoteric, and it's about how to predict the movement of how to predict how your independent variable in a closed system moves, and fibs are just not going to do it. Now, I think we went through everything, but we went through the analytics, we went through the dots, we went through the pivots, we went through the quants, we went through this. I think that's everything. That's it. I mean, I think that's it. I mean, this is a full platform, and this is everything that there is to trade, with everything trying to confirm everything else. And really what this is trying to do is get you in a trade with institutional participation, and in which there's a multi-time frame alignment and trend of multiple markets. And I'll just give you this as theory, and it's just a little bit. If you take this box as a closed system, and let's say that there's a little doohickey inside here. Now, I mean, a nice closed system could be like helium. And let's say that you want to predict how this is going to move inside this box. Now, if no energy or forces are brought to bear on this dot, the laws of thermodynamics tell us that the dot's going to move in random direction, because all closed systems always move in a state of maximum chaos. So it's simply a law of nature. So in order to get this dot to stabilize and move in a predictive direction, you have to bring forces to bear on it. Now, if that dot was the market, it would be money. And money is what creates chaos, which is what creates order out of chaos. So if this line was money, money would make this line move in a direction that we could predict. And what does money do? It creates order. And it's going to create order in a way that we can assess it. And the way we can assess it is that we get a multi-time frame alignment of trend. The other is that are correlative markets, in which there's the movement of it's looking at money moving from one asset class to another asset class. If money is flowing into here, it has to come from somewhere. And if the money is substantial, and that's what we want, it's got to come out of certain markets and move into here. So that's all we're doing, is we're looking. Now, in a closed system like this, where all these forces are not coming to bear, you're going to get chopped. And that's what happens when they're non-aligned. Here. the market just, I always used to say to myself, who makes money in chop? Why would the market ever chop since everyone seems to be losing money? And the reason it's just the law of nature. If you don't have the major force being applied here, which is money, order flow, stochastic, and momentum will not align. The multi-time frame alignment of the market you're trading will not align. Correlative markets will not align. Nothing will align. And anytime you try to trade in here, you're going to have problems. When money starts pouring into this market, everything will start to align. The trend of the market you're trading, the trend of correlative markets, as evidenced by the dots, and by the quants. And that's really all it is. It all comes down to that. Now, thank you, John. If we could have one indicator that could track money, we could eliminate every indicator, but then everybody would never get a losing trade. So we're never going to be able to track money. We can only chase its trail. And this is really following the footprint of money. And just to give you one last example, like when I trade options, what I do is I look for other big options trades. Like I have Benzinga, and what I look for are multiple other traders pouring in call options at a specific strike price and at a specific expiration. And normally, if you get people placing $250,000 options trades on a specific, in a specific stock, and then you do an assessment of the stock and you like it, you have a high likelihood of that stock going up. All you're doing is chasing money. And that's everything that we're trying to do here. So if there are any questions, now's an opportunity to ask them, because I think you've got everything here. Any questions? Okay. All right. Well, listen, everyone. I'll slice this off from the charting and during the day, and I'll send it out to anybody who would like it. And I'm not going to send it to everyone. Just send me an email if you'd like the recording. So listen, have a great weekend. I think the NASDAQ is going to give us a tremendous advantage. No problem, Donovan. No problem, Draw. Thank you. And we got you, Donovan. And I think we're going to have great opportunities because the NASDAQ gave us the chance to break back, and it gave us a $325 trade at the end. Thank you, Eddie. I think Monday is the day. Sergio was trying to get it done by today, but simply because he's had a lot of traders call him and ask him for help, he will have it done on Monday. So we are right there. By the end of Monday, we should have NTA done. So we're a day away. Thank you. No, thank you, Khalid. You too. So everybody have a nice weekend. Listen, if you just have a little bit of screen time with the platform, it's so easy to trade. You just can't miss anything. And I missed something today, and it cost me a trade, which is really, really. I don't want to go find it. I won't find it and torture myself. But I took a trade without the 3 line, and you really can't do that. I can't remember. I don't think we. It was here. Now we got this perfect up move. Unfortunately, it shook us out. And we got this great down move. And then there was really nothing. And you see, I just want to show you right here. Look at this roll down here on the NQ. It just made it, I think. Let me see if it did. It did not make it. You would not have made 20. And you don't have that intermediate, and you don't have the major. So you would avoid taking a trade that went less than 20. If I'm at 17 or 18, I'm gonna have my finger on that close button, because I'll be darned if I'm gonna let that 17 take trade come back and stop me out. But this would not have gone. This one would have, and you had the intermediate here. It's still sort of a risky trade, but if you wait till here, where you get the oscillator and the dot and the background bias right here. This is the weakest background bias, but at least you have a multi-time frame alignment. No problem, D. I've had a lot of people asking me about the 6J, and we will look at the 6J. What we may do is not look at the 6A, and instead we'll look at the 6J. And right here, you have a short trade. And you can take it on the next candle if you have the signal, and this gives you a really nice trade. This is a 30-tick trade. So I think the NASDAQ next week will do great for us. Everything set up allows us to avoid chop, and I think we can get into some nice moves, and not having the bane of crude, which is somewhat untradeable. So listen, everybody, have a great weekend, and let's hit it Monday. I'm actually waking up excited to trade because I really like the challenge that the NQ poses. You can't sit back and relax for a second because you get tons of potential entries, and you got to confirm every one. And you have the potential to miss one, just like I missed this one. Even this huge wick would have definitely given me a heart attack, because this came back 24 ticks, and it didn't stop us out. It gave an equal low, but it didn't come one tick below. Oh, it's all the way down there. So we were still good. But that I'm telling you, that's a lot of, that came back a long way, but still, it's a winner. All right, everyone, great. Have a great weekend. Any additional questions, call me. We will chop it, and see you Monday, D. And let me just go back. Donovan wants the copy. All right, everybody, take care and have a great weekend. Bye-bye.